Schlossberg is with us. He's global strategist at Wells Fargo Investment Institute. He's joining us now. Gary, great to have you with us here. Thank you very much. You've been cautious, Gary, last few times. You've been calling this in the U.S. a bear market rally. Is that still the case? And is that, maturing and winding down now? What's your sense?
Well, we're staying with that projection. We haven't even entered a recession yet. We still are looking for a recession to take place during the first half of 2023. And as we enter that recession, earnings estimates, the earnings outlook, we think still has room to move lower, and that will create an added headwind for the stock market. As well, the Federal Reserve raising interest rates still could create a headwind as well for valuations. Taken together, that will create, we think, continue to create a difficult environment for stocks for a time before the market can get some visibility on that recovery later next year.
Gary, morning. Rima here. What's the read in China now? Are you getting the signs that China is preparing to pivot away from its stringent COVID policies? They are looking to up the vaccination for elderly, which is seen as a precursor to a broader reopening eventually. And if that is the case, does China make more sense from an investment point of view, considering that valuations are far more reasonable there and there is that element of underperformance?
I think the move away from a zero COVID policy is somewhat nuanced. There are some risks along with that. China's healthcare system doesn't really have the capacity to deal with a big ramp up in infections if that is the case as they relax that zero COVID policy. There is also the question of how effective the vaccines are in China. So that's one issue. And then out beyond that, they're still dealing with a weak property sector, and that property sector of the economy had been a major driver of economic growth over the past decade. And then on top of that, the overseas markets are winding down, will continue to do so in 2023. And we're already seeing that effect blunt any improvement that we would like to see in China's trade balance as a driver of economic growth. So yes, the easing of a zero COVID restriction does clear a little bit of the uncertainty out there, but we're still looking for a very moderate growth recovery in China over the next 12 months.
Hi, Gary. Morning. So you stick to India in that debate between India and China, right? At current reckoning.
I think so. Valuations are certainly an issue, but the growth outlook, even though we do expect to see it losing some momentum over the next 12 months.
Right. All right. From an India perspective, Gary, we'll be tracking the central banks in the next week or so, both in India as well as the Fed. And the Fed chair will be speaking later today. What are you penciling in? The street seems to be divided with regard to what the Fed will do, a 50 or 75 basis. What do you think is going to be the outcome of 50 would be, read as more dovish. But do you think we'll get that? And what about the RBI? The last time you were saying that, you're expecting rates to go up even here in India, which could be par for the course.
Well, as far as the Fed is concerned, we're leaning toward a 50 basis point rate increase based on the economic data that we've seen of late, particularly the fact that inflation here in the United States has peaked. The other question, however, the other issue out there is to how long the Federal Reserve will be raising rates. What will that terminal rate be? And I think there's more uncertainty about that in the market. Overall, I think the market will remain cautious toward the Fed's policy outlook. As we move into 2023, we do expect to see those rate increases stretched out and modified, quarter-point increases, perhaps 2 or 3 in 2023. We're still looking for the Reserve Bank of India to maintain rate increases as well. And there, too, though, we are beginning, we think, to see the tail end of that tightening cycle as we move into 2023. So pretty much keeping pace with the Federal Reserve. Unfortunately, that means that growth, given the lagged impact of rate increases, will create a headwind for the Indian economy next year, although growth compared to some of the other emerging markets, we think will continue to hold up quite well. And for that reason, we continue to find India an relatively attractive market within the emerging market space.
But you did say that growth outlook in India may see some softening in the next 12 months. If that's the case, is there a risk that valuations in India come down? There is some derating?
There is that risk, given the level of valuations. We could see interest rates level out, come off a bit. That takes some of the pressure off of local valuations in India. But at the same time, the growth slowdown that we're looking for will be, we think, a good deal less pronounced than it will be in China. Even as growth firms in China, Indian growth will be a good deal stronger, we think. And the slowdown elsewhere in the emerging market space, we think, will be more pronounced. So it's all on a relative basis, a more difficult year for India, but less so than other emerging market countries.
All right, Gary, we'll leave it there. Thank you very much for your time here. As always, it's a pleasure having you with us on the program. Some sobering news coming in earlier today, and this is actually